So, did Fed Chair Powell break the stock market after all? That's what we are asking here today as the markets take a big wallop. We're going to try to figure out what happened and what it means going forward. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we'll start with first and foremost is a look at the price action and what it is that these markets showed us today. Because, of course, as we'll find, there is seemingly more in the price action than there is in terms of its justification. There is very little event risk that stands out right here to show us how we ended up with this sea of red. And it is risk aversion seemingly at its most classic. So stocks, of course, we see are down. No big surprise there. Significant losses for the S&P, significant losses for the NASDAQ. But and if we might as well make note here right from the start, Bitcoin back apparently to doing its amplified risk sentiment thing, where when stocks go up, it goes up more. When stocks go down, it goes down more. That seems to be back to where we've come here, and down more it really is. Bitcoin off over 7% here. As we look elsewhere, the mix starts to get really interesting because whereas we have had a significant pickup in yields over the past week, and more on that in a moment, here yields actually come in some. And perhaps what's most interesting about this is they come in some most at the long end. We can see the 2-year basically neutral here, generally unchanged. It's at the 10-year where we see a downtick of almost 0.5%. And that seems to give all of this a little bit more of that risk-off sort of vibe, where it's not so much that it's this catalyst or that catalyst, or where we've priced in this or that for the Fed or whatever it is. It's more like capital is flowing to defensive assets, to those assets that typically thrive in a defensive environment. When we look at, incidentally, the decline in gold, it becomes very clear how not a safe haven it actually is. People talk about gold as a safe haven because it oftentimes goes higher when yields come in, which in turn happens in periods where the markets are somewhat defensive. And so there's an incidental thing there where stocks might go down, there's risk aversion, bonds go up, yields come in, gold might go up in that environment because yields are lower and it yields nothing. But that need not be the case. In fact, all of 2022, say, when yields were going up as stocks were declining with the Fed rate hike cycle, gold was falling right in tandem. And what we see, of course, in the most recent weeks and months is that gold is kind of decoupled to some extent from both the dollar, one of its main foils, and yields, the other one, largely around this idea that it is more so a kind of multipolarity asset, a kind of go-between. If the U.S. and China, say, were to drift apart, if deglobalization were to become more entrenched, and you were to look at more of a confrontational relationship between the two major powers, and they had their own economic spheres, as China has attempted to carve out, especially in the wake of the sanctions that the world has taken against Russia following its invasion of Ukraine and sort of the display of economic weapons there. The go-between asset for third countries that might want to do business with both silos, as it were, the China-led one and the U.S. one, that's emerged as gold. Now, whether those silos actually occur, who's to say? But the speculation is certainly there, and the animus is certainly there. So as we look at what gold has been doing, it's been less linked to anything in terms of its more classic drivers, and has, in a sense, become the same kind of speculative vehicle that stocks are, just for a different story, for a different narrative. And so we see, as markets apparently have gone to unwind their exposure to the major themes of recent months, gold is down with stocks, not up because it is acting as some sort of a defensive vehicle, but rather because it has speculative froth to clear of its own. The euro down as the dollar gains. And interestingly, again, to give this an even firmer risk-off sort of thrust, the yen is up. The yen is a kind of classic beneficiary of risk aversion in environments where essentially the market becomes almost correlation one defensive, where one kind of universe of assets is the risky universe is going down, and the more defensive, more sort of liquidity haven universe, like the dollar, like US Treasury bonds, when that's going up, you typically get a situation where there is a defensive unwinding of carry trade exposure, and that's oftentimes financed by de facto being short the yen. So when people are unwinding that exposure, you oftentimes will get this this kind of a dynamic where the yen goes up and the dollar goes up. The dollar goes up generally on sort of liquidity haven grounds, as do bonds. For the yen, it's more a story of just the defensive mood being an unraveling of yen short exposure and a sort of buying back of that exposure that gives you this rise. Nevertheless, the dollar is firmly higher here across almost all of its major counterparts, and certainly the euro story sort of captures at least the general sort of thrust. And so naturally, as we see this kind of aggressive risk-off thing, the question becomes, well, what in the world happened? And perhaps the most straightforward way to approach it is to sort of look at what didn't happen and go by the process of elimination. Now, to be sure, markets have tended toward a clearly defensive sort of thing in the wake of the Fed policy announcement last week. In fact, we can see here that when we look at overall performance last week, stocks actually edged out a little gain. We see, of course, in the rise in yields what ultimately ended up happening, but all of this looks much more staid, especially on the risk sentiment front. Bitcoin is neutral, so you don't get the kind of panicky thing that you start to notice when you simply look just after the Fed meeting. And clearly, there is a difference in tone. Since that Fed meeting, stocks are down, yields are up, gold is a little bit lower, but more importantly, the dollar is significantly higher, and Bitcoin is way off. All of which seems to reflect this idea, as we've talked about here at length over the past week and a half, that coming into last week, the markets were essentially priced for perfection. They had three pillars that were holding them up. Number one, the Fed was going to deliver a rate cut and probably not say anything off-putting about another cut to follow in December. The second, that tech earnings were going to go generally okay because tech results had been outperforming the overall market, with revenues and earnings growing faster than market average. Tech earnings were growing at about 22% odd. The the S&P 500 average was around 9. And the third thing, that the meeting between the U.S. President Donald Trump and Xi Jinping, China's president, was going to be generally cordial, that there would be a kind of walking back of the immediate hostilities where rare earths would get unlocked at the same time as Chinese companies, subsidiaries of U.S., let's say, monitored and listed firms for sanctions, that they would get essentially to go free. That was part of the recent escalation. And that essentially we'd go back to where this thing stood before things started to get off kilter in early October. That essentially we'd walk back U.S.-China relations to October 1st, give or take. As far as China went, that worked out. There was a sort of rubber stamping of the intent to cool things off by the two leaders, and everything generally passed as markets expected. On the earnings front, a little bit of a miss for Meta, but generally nothing untoward there. In fact, if we look at the way that earnings so far this week have materialized, the big names are largely already out. Palantir, a little bit of a beat. Same thing for AMD and for Uber. Those are kind of the big market cap names, and not really all that great as far as the price response. Certainly not helping with what we're seeing here as these markets sell off. And as we look at what then seems to be the problem, it was the Fed and Fed Chair Powell's sort of grenade throwing at the press conference following the policy announcement. The cut appeared exactly as anticipated. There was nothing ultimately that spicy in the statement, although the Fed sort of bemoaned the absence of timely economic data around the U.S. government shutdown. But we can clearly see, looking at what's happened with the probabilities for December's meeting, that there was a sea change in expectations. Right now, we're basically 70-30 in favor of a cut. That's obviously a huge change versus the over 90% likelihood just a week back from today. So that Powell came out and very clearly said, look, you all seem to think that December is a foregone conclusion. Let me be very clear, it is not, and far from it. And the markets haven't looked back since. Again, here is what we've done since he said those things. Stocks down, yields up, gold down, dollar up, Bitcoin off significantly. So clearly, whatever is occurring here, the Fed was the breaking point and perhaps need not have been. If any one of those three pillars that we just listed had generated something other than what the markets were expecting, you might have expected a similar thing. And that seems to be how we end up with this ongoing slide today. It isn't so much that there was event risk and this is still the lingering response to whatever that event risk was. It's more a sentiment shift whereby the market started last week seemingly priced for perfection, and when that perfection didn't arrive in whatever guise, there was likely to be a speculative reshuffle, and seemingly that's exactly what we're looking at here. Now, looking at the way these Fed expectations have evolved, even since yesterday, we can see not a big change. So it's not as if this sell-off now as opposed to the drift in risky assets yesterday, seems to have been somehow catalyzed by a further unraveling of rate cut odds. In fact, they've actually ticked up a little bit today versus where they were yesterday. If we look at what's come from the economic data side of things, we didn't get jolts. The government shutdown continues. We did get the ISM manufacturing PMI numbers earlier in the week. The services sector component of those surveys is coming up tomorrow. That is by far the most sort of potent indicator of U.S. economic activity in the absence of government data, because of course the services sector is by far the largest employer and the largest share of the economy, about 70 odd percent of the overall economy and maybe 80 odd percent of employment. No big news from the RBA overnight. They keep rates unchanged, and ultimately that fades into the overall narrative. The services side here for ISM expected to tick up just a little bit. It was at standstill in September. As ever, these are centered around 50, where that's neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So if you go from 50 in September to 50.7 as expected in October here, what you've done is you've increased the pace of growth slightly from basically nothing to a little bit of something. When you compare that with what turned out to be an unexpected acceleration and contraction on the manufacturing side, you probably end up with an economy somewhere idling, because the outsized contribution of the service sector would sort of tilt you in the direction of that being weighed higher in the average than the manufacturing side. So because of that, and because that side's the one that's ostensibly growing, you'd end up somewhere near standstill, give or take, taking both of those two together. Looking at what's then coming up later in the week, really it's just the University of Michigan Consumer Confidence report that is slated for Friday. Now, maybe we'll get a breakthrough in this government shutdown and jobs data actually does come out, but it's unclear. And at the moment, there's no sign that that is where things are going. So for the moment, this is what we're looking at. And the most interesting thing here ends up being that we were looking at sentiment really just operating as a function of inflation, where from the beginning of 2021 until really the beginning of this year, when inflation expectations rose, sentiment deteriorated. When they fell, sentiment improved. And we can sort of follow this narrative very clearly. Here's inflation expectations accelerating until the Fed really gets serious, and sentiment is declining as that's occurring. Once the Fed really starts to hike rates and clamp down, inflation expectations decline, sentiment improves. That continues until the beginning of this year, when, of course, inflation expectations surge thanks to the tariffs that have been unveiled, and sentiment declines again. Once the sort of worst of the fears around Liberation Day and sort of that early April kerfuffle start to fade, sentiment improves a bit, but now what we've seen over the past 3 months is something else entirely. Sentiment seems to be deteriorating even as inflation expectations cool. And that's suggesting a defensiveness about the consumer that's new and interesting, perhaps anticipating some kind of level of exhaustion and some kind of more significant headwind for consumption. That, of course, would be very concerning because, after all, 68% of U.S. GDP is household spending. Now, this is where the rest of the week becomes an exercise in what is the narrative that drives. So looking at Fed policy expectations, to the extent that what we might see out of this data moves the needle here, maybe we manage to check whatever sentiment shift is now underway. But the markets are already deeply on the dovish side of Fed policy expectations. They've got 63 basis points in easing on the menu for next year. That's at least 2 cuts and about 50-50 on a third. Looking at what's going on for Fed's policy expectations as they see it, it's a measly 1 cut. So if we consider then what this data might show, if it ends up disappointing, maybe we get a little bit more by way of Fed rate cut speculation. But even with the recent unraveling, December is still better than even odds. And next year is already more dovish than the markets were hoping for the Fed to endorse. And clearly they've not endorsed it. So what we see here is, despite expectations seemingly starting to moderate a little, at least after last week's shift, sentiment is nevertheless looking like it's unraveling a bit, and importantly, a bit. Obviously, there's a commanding advance here that's still very much there, but clearly the price action is noteworthy here, and the dollar continues to revel in a recovery as we get less dovish of a view against the back of all of this. We end up with a dollar that continues to bounce from these lows in mid-September, incidentally lined up with the Fed's meeting that month, where it retested the bottoms in July. Notably, it was in early July when the dollar seemed to hit a low. It hasn't set a fresh low since. And that seems to be very much a part of this overall story. Now, U.S. economic data, just judging by the tone of what's been going into the Atlanta Fed GDP Now model, that's the green line there, it seems to suggest that the U.S. economy is actually looking like it is accelerating. That would line up with at least some of the recent data. For example, the S&P Global PMIs that came out just a bit over a week ago. And we can see that even the consensus view that's been sort of shaped by what data there has been, at least going into October, even that gave us a potent revision pointing higher to what markets are expecting. So we, if anything, might get the kind of data this week that actually makes rate cuts less likely if the economy seems to be getting a perkier. And of course, with sentiment the way it's set up and the response, again, that we've seen since the Fed told us that the scope for easing was not as great as anticipated, that doesn't bode well for risky assets. As far as exposure, I still have my short gold exposure, both via the futures and by selling a call vertical here. That's working. Still long the US dollar, short the Aussie, the pound, the euro, the Canadian dollar. Still have my long-term exposure to Brazilian markets via EWZ here, which was one of the few things that didn't work today. But of course, this is a longer-term view. There's still all kinds of time in it, and it's well on the profitable side of things already. So we'll see if that continues to be the case. Short Bitcoin through a put vertical, short the S&P through a put vertical on SPY, the ETF, long the long end of the bonds through call verticals on TLT. That seems to have found a helpful bottom today. We'll see if that continues to hold, and short a bit of crude oil through a put vertical in USO. That fell with general risk aversion. Today, we'll see how that continues to evolve going forward. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I'm also writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.